Ondas Inc. is trading right now at $7.87 during this live intraday session, marking a noticeable move upward of 2.48% from its previous close of $7.68. As the tickers tick across popular investing sites, the stock has hit an intraday high of $7.94 after opening at $7.52, bouncing off an early intraday low of $7.31 with heavy trading volume exceeding 28 million shares changing hands. While short-term day traders on various platforms are watching these quick percentage gains with excitement, the hidden story behind this move completely breaks from standard market logic. Most people assume that when a small-cap tech player gets added to a major benchmark index, it triggers an immediate, sustained flood of institutional buying that permanently lifts the share price. The expectation was a smooth upward path after the index rebalancing, but the reality is a complicated tug-of-war between passive index replication trackers and a massive block of newly registered resale shares that are hitting the market at the exact same time. This massive supply shock has created an incredibly volatile environment where mechanical index buying is fighting directly against immediate insider liquidations, completely catching retail buyers off guard. This technical friction is precisely why looking solely at a basic chart without understanding the underlying structural equity filings can lead to massive unforced errors in your personal portfolio management strategy. The general belief among casual onlookers using a basic individual brokerage account is that this company is just another speculative drone play riding on the coattails of larger industrial technology movements. People look at it and think it is just a high-risk micro-cap lottery ticket that moves purely on retail sentiment and internet hype. However, if you examine the underlying institutional data available on the Interactive Brokers platform, a completely different picture emerges. The conventional retail narrative fails to capture how deeply entrenched this company's proprietary wireless technology has become within heavy industrial infrastructure, specifically Class 1 railroads and major defense networks. This is not a simple consumer drone company. It is an infrastructure provider building mission-critical communication pipelines that cannot afford a single millisecond of downtime. When you look past the daily price noise, the contrarian view reveals a company that is successfully moving from speculative pilot projects into massive multi-year commercial deployments, even as the broader market continues to price it like a struggling startup. This deep disconnect between retail perception and industrial adoption is exactly where the real tension lies for long-term allocators who manage their capital through professional channels or even sophisticated self-investing strategies. To understand why the price is swinging so violently today, we have to look closely at the massive structural forces that have hit the tape over the last few weeks. The stock was riding incredibly high earlier this month, reaching peaks near $14 as excitement grew around its formal inclusion into the Russell 3000 index. For a company of this scale, index inclusion is a massive milestone because it forces institutional mutual funds and exchange-traded funds that track the index to automatically purchase millions of shares regardless of valuation. However, at the exact same moment that the passive buying engine kicked into high gear, the company filed to register 3.38 million acquisition-linked shares for resale. This created a perfect storm of opposing forces. On one side, you had automated institutional buying, and on the other side, you had a significant group of early investors and acquisition targets looking for immediate liquidity. This explains why the stock collapsed from its $14 highs down to the mid-$7 range within days. On modern platforms like the Robinhood app or through SoFi Active Investing, this sudden 30% drop caused by an institutional resale filing could feel completely unpredictable. On the flip side, users managing automated accounts through Schwab Intelligent Portfolios or a specialized intelligent portfolio service tend to see these positions heavily managed within diversified thematic baskets where single stock volatility is muted. Meanwhile, active traders who prefer direct access tools often migrate toward the Interactive Brokers platform to minimize Interactive Brokers' fees or maximize their execution speed during heavy volume events. Whether you're using a premier individual brokerage setup or navigating a standard online investing platform, understanding the plumbing of the market, how shares are registered, sold, and absorbed by institutional blocks, is vastly more important than simply watching a green or red chart wiggle throughout the trading day. This distinction becomes even more critical when analyzing firms that operate at the intersection of heavy industrial engineering and cutting-edge software applications. Let us transition into what this business actually does and how its core operational model is built to capture market share over the long run. Ondas operates through two primary business units: Ondas Networks, which specializes in private, high-capacity wireless data networks designed for critical infrastructure providers like major railroads, oil and gas utilities, and government entities. Their proprietary technology provides the foundational communication layer for automated systems, allowing industrial operators to monitor miles of tracks, pipelines, and remote assets securely without relying on commercial cellular networks. The second piece of the puzzle is American Robotics, which focuses on fully automated drone-in-a-box solutions designed to conduct continuous inspection and data collection missions without requiring a human pilot on site. The commercial synergy here is that the drones require an ultra-secure, industrial-grade wireless network to transmit their data over long distances, which is exactly what the Networks division provides. This combined business model aims to lock in long-term enterprise customers who pay significant upfront hardware fees, followed by highly predictable recurring software-as-a-service revenues for ongoing monitoring and data analytics. Looking back at their historical financial performance reveals the classic trajectory of an early-stage industrial technology business trying to establish a brand new market segment. In past years, their revenue lines were incredibly small and lumpy, driven almost entirely by small-scale pilot programs with a handful of regional customers. Older reports showed massive net losses and significant cash burn as the company poured capital into research and development to perfect their wireless protocols and secure regulatory approvals from organizations like the Federal Communications Commission. For instance, looking at their older financial summaries from previous quarters, the company frequently reported negative operating cash flows that required dilutive equity financing rounds just to keep the lights on. Many traditional investment managers using standard evaluation tools on the Fidelity trading platform or reviewing Fidelity mutual funds would immediately red flag the company as a cash-burning venture, but the expectation of permanent unprofitability is now clashing with a reality where revenues are finally scaling up, as evidenced by their recent quarterly filings showing a distinct acceleration in top-line growth as pilot programs convert into full-scale industrial deployments across North America. As we look toward the future, the central question for anyone engaged in online investing is whether this business can successfully cross the chasm into sustained free cash flow positivity before its remaining cash reserves run dry. There are several clear catalysts on the horizon that could drive a massive re-rating of the stock. First, the ongoing commercial rollout of their rail communication systems represents a multi-billion-dollar total addressable market where they face very little direct competition due to the extreme regulatory and technical barriers to entry. Second, if the federal government or international aviation authorities pass more favorable regulations regarding beyond visual line-of-sight drone operations, it could instantly accelerate the commercial adoption of their automated drone units across millions of acres of agricultural and industrial land. However, the risks are equally clear and must be weighed carefully by anyone engaged in online investing. The company operates in a highly capital-intensive sector, and if their enterprise sales cycles take longer than expected, they may be forced to execute additional dilutive share offerings, which would place a hard ceiling on how fast the stock price can recover. This balancing act requires extreme discipline from retail participants who are trying to figure out if the asset fits their specific individual brokerage goals. To survive and thrive in this space, a company can't just rely on great engineering, it must also master the complex procurement cycles of massive corporate clients who are notoriously slow to adopt new technologies. For example, when a Class 1 railroad decides to upgrade its communication network, the testing phase alone can last for multiple years to ensure compliance with strict federal safety standards. This means that while the long-term contract value might be massive, the timeline to actually realize that revenue can severely stress a small company's balance sheet. Investors who utilize advanced online investment methodologies or rely on professional investment help understand that patience is a mandatory requirement when backing industrial tech platforms. If you look at the current institutional positioning via Fidelity Wealth Management profiles, you can see that the big players are willing to sit through these multi-year validation cycles because they know that once a technology is integrated into a railroad or an oil field, it's almost impossible for a competitor